Folks, I am in shock. On live TV, one of CNBC's biggest bears just capitulated and said the bear market is over. I want to react to this and hear out what this gentleman has to say. If you know, I've covered this guy a few times. Steve Weiss, Short Hills Capital. He's calling that the bear market's over. This is one of the biggest bears and one of the biggest naysayers on the market, how stocks were going to perform this year and all these sorts of things. And he looks like he is flipping. So, oh my gosh, flipping my flapjacks. We're going to react to that one. And then I figured we'll react to this one as well. Might as well do a 2-for-1, buy one, get one free. Wells Fargo warning to investors, a Fed is not your friend. I want to hear what they have to say in regards to that one. And by the time this video is out, by the way, we should have our the once-a-year sale for Valentine's Day should be on. So if you want access to that, it is for my Become a Master Stock Market and my Dividend Investing Mastery course. Check out the pinned comment down there. Those are all the different subjects that this course helps out with. So if you need help with any of those subjects, definitely check that out. And that will be pinned comment down there to take advantage of that deal before it ends. It's pretty epic. So definitely check that out. It's my most popular 2 courses I've ever done. Let's get into this, guys.
Looming large. We get you set up for that with some fresh moves from the investment committee. Joining me for the hour today, Jenny Harrington, Steve Weiss, Joe Terranova. Everybody's at the table. Happy to see everybody here. Let's go to the wall, see what we're doing. 12 noon in the east. We've got green across the board, as you see. Dow's good for 285, we'll call it. S&P near 1%. NASDAQ outperforming today. Yields at 372. That is on the 10-year. But, Joe, we're waiting for the CPI. J.P. Morgan games it out, as they always do, and we like to bring our viewers that information, sort of what they're talking about, what the likely outcomes are, and what the result will be in the stock market. 65% chance, they say, it goes between 6 and 6.3%. Okay? Remember, it was 6.5 last time.
Okay.
That's bullish, they suggest. Get a 1.5 to 2% pop, but you see the rally faded. My point is, like, you got a bunch of potential outcomes, and we're hanging on this next big hurdle for this rally.
It's interesting because
Before I get into that, my opinion is my personal opinion on where we'll come in at here. I think we'll likely come somewhere around, my guess is around 6.3, 6.4. Somewhere around there. That's my personal opinion. Could be off on that, but I'm thinking 6.3, 6.4. That's my expectations. Now, in terms of me, it doesn't matter. Like, do whatever. Crash the market 3%. Have the market go up. Like, for me, I'm in a win-win situation, right? Market goes down a ton. I'm hedged, so that's good. And also, I would just get to buy stocks for cheaper prices. If the market stays around here, it's fine as well. Great opportunities in the market to be a buyer right now. And if the market goes up a ton, that's phenomenal as well. I get to make silly money on that, right? If S&P goes up 2.5%, 3% tomorrow, I'm going to be up 6 figures, if not multi-6 figures in my portfolios likely. So, any way you slice it, it's a win for myself.
My point is, like,
anybody that has a long-term investing philosophy that's similar to mine, it's like, doesn't matter what happens. Literally, we're in a win-win situation.
Bunch of potential outcomes, and we're hanging on this next big hurdle for this rally.
it's interesting because I actually see the pressure being on bears, not so much the bulls.
Absolutely.
I think bulls are in control here. I've said this all along. I think you've got a little bit of a runway through the spring where the market can rally, and then the lag effect of what monetary policy takes effect. But inflation and the report that we're going to get tomorrow, we know there's going to be several distortions. The weightings have changed for how it's going to be calculated. So owner's equivalent rent now has a higher weighting. That's up to 25%. The shelter component is going to be a little bit hotter than expected. In addition, used car prices, which in January were up 2.5%. That's the first increase that we've seen since June. The used car pricing is actually going to have a lower weighting. So there's going to be some distortions in the report. Understand that. I think the good side of the economy is going to look better. I think the services side of the economy is going to look more difficult. And I think the road for inflation is going to be bumpy. But unless you see a very hot number, when I say a hot number, I mean month on month up 0.6, core up 5 to up 0.6. Last month we were up 6.5 year on year overall. I think you need to see up 6.5 year on year overall, because if you fall in that 6.
The Pinduoduo, that's been one of the hottest stocks in the market. The stock is on fire.
6.3 area, market's going up.
So, Weiss, the bulls are in control. Okay, that's what Joe just said. You agree with that?
I
For now. You do. Come on, you do.
Actually, I don't agree with the characterization. I don't know that anybody's in control right now.
Only you
That's
could
what I
come
was
up
gonna
with
say.
that. Only you would put yourself into a pretzel twist to come up with that answer.
No, you perceive
the stocks have been rallying, right? It's been hard to push the market down, right?
Yep.
The bulls feel like they have some newfound momentum. Wouldn't you agree with that?
No, I definitely see this momentum. I continue to see cherry picking of good news in a sea of what could be bad news. So look, if you were counting on this being a deep recession at this point, then clearly you're wrong. I don't know that anybody was, but that was a headline dialogue because it was sensational. Similarly, I think it's completely asinine to think the Fed's going to pivot and all of a sudden start cutting rates at any point this year. They're not going to make that mistake. So where are we? We're still in the case, as Joe alluded to the lag effect of monetary policy, which I believe will hit mostly at the end of this year. Mm-hmm. And we're still in a multiple expansion phase of the market, which defines momentum. So there's no basis now.
You think we're still in a bear market?
I think we're basically in a very narrow trading range. I wouldn't call it a bear market.
So you don't think we're in a bear market anymore?
No, I think we're in a very narrow trading range in the market. We're going to go up, we're going to go down. Is the risk more to the downside than the upside? Yes, because how long can multiple expansion go up? But to me, I define bear markets as going down 20%. We're not.
The thing this gentleman's not even taking into account, and this is very, very important. Let me let him finish, and then I'll get into the point that he's totally missing that is, in my opinion, so obvious, but he's just completely missing this. But I'll let him finish.
Go down 20% from here necessarily because there's too much money that wants to come in.
So even you, who is more negative than most, don't think we're going back to put new lows in?
I don't think we'll put new lows in, but I still think that towards the second half of this year is going to be extremely challenging. And all the people that have been walking around the streets or riding their tractors saying, I'm right, despite the market still being crushed, are going to be disappointed. So I look for idiosyncratic stories where I believe that the valuation is reasonable. I expect that the earnings nose, like a deer, can still go lower, but I'm comfortable that they'll recover. And I think we've seen that. So it's all about positioning in idiosyncratic risk. I'm not playing the market.
Okay.
I'm playing specific stocks.
All right, so let's talk about positioning a little bit. Jenny, so Wells Fargo says the bear market is over. Mike Wilson today says not only is it not over, but the bear market rally soon will be. Okay, here's what Mike Wilson says.
Mike Wilson basically doubling down on the whole bear market. Okay, and don't worry, I'm going to come back to the whole Steve Weiss point that he's missing here in just a moment. I just want to finish this out here. Interesting. So, yeah, okay, Mr. Morgan Stanley's doubling down on it. Wells Fargo saying bear market's over. Okay.
Is not reflective of the deteriorating fundamentals or the fact that the Fed is hiking during an earnings season, drivers that should ultimately determine the lows for this bear market later this spring. Bottom line, we don't advise waiting for the obvious signal the bear market rally is over. We recommend positioning now for the end of the bear market rally, is basically what he's saying, in anticipation of the moment of truth before it's obvious and too late. What do you think?
Well, I think they're both right. And I know that's a pretty lame answer, but it's interesting listening to both.
It's a very Weissian answer.
I'd say it's between all of us. But it's interesting because you listen to Joe, and Joe says the road for inflation's bumpy. Of course it is. The road for the market's bumpy. Everything's bumpy. Weiss says that you need to people are cherry picking.
Did you what I said?
Yeah,
she's writing
I always do.
Wow.
So you need to be careful because when you take pot shots, no, I'm not giving you that.
Oh, what? No, come on, man. Oh, man, that was about to get good. She was going after him. Oh, dang. If somebody finds the full clip of that somewhere out there, okay, send that to me on Instagram. Send it to me in a DM, please, if you find the full clip of that. Oh, man, she was going after him. Okay, so what's that gentleman missing, okay? The one thing that gentleman's missing to take into account here, that's extremely important, is what if earnings strengthen for the strongest companies in the world throughout 2023, and they get stronger and stronger? What if margins start to expand as 2023 goes along? What if net income starts to expand? And although it might not be in a super exciting revenue year, what if revenue is okay? And I don't even think that Steve Weiss gentleman is taking that into account, and that's a realistic possibility. When you go through the S&P 500's biggest components, right, the 1% plus weightings, and you go through the NASDAQ 100, most of those companies are going to see their net incomes and EPS actually go up this year in 2023, not down, up. And I think a lot of these bears don't even take that into account. And it's like they're just talking about, multiple expansion, this and that. And it's like, well, you do understand the market's maybe looking 6 to 9 months in the future. And maybe the market's seeing that a lot of these companies are going to come around and their earnings are going to get stronger. These are things you just have to take into account. They seem to take into account, a possibility of recession and, the economy getting worse or earnings getting worse. And it's like, we take into account the other flip side of that? But they don't do it, right? And that leaves them kind of blind in the market and obviously sets them up for massive losses as we're seeing play out, right? Wells Fargo warning to investors: the Fed is not your friend. Let's hear what they're having to say here.
Ahead of tomorrow's data, Michael Schumacher is the firm's head of macro strategy. Michael, in what way? Higher for longer?
Higher for longer, that's right, Melissa. So you think about the history over the last 15 years. Whenever there's weakness, the Fed rides to the rescue. Not this time. Fed cares about inflation, and that's just about it. So the idea of lots of easing, forget it.
So tomorrow, what should we be looking for? I mean, Karen walked through a scenario in which there was upside to stocks in both scenarios. I mean, the market has it in its brain that there's going to be no recession or there's going to be a soft landing, and that, that's good enough for equities at this point.
It seems odd, though, right? Because if there truly is no recession, and I'm a skeptic, but if that's the case, why is the bond market pricing so much easing for next year in particular? There probably should be less easing priced if this no recession idea comes to pass. And in that case, higher yields, that doesn't sound good to stocks, to me at least anyway.
So you could look at that either way, right? You could look at the bond market and say, oh, the bond market's showing that, recession's coming. Okay, what if we look at just the flip side, right? What's the stock market telling us, right? And you say, who's right, who's wrong, who's smarter, the bond market or the stock market, right? And you say, why are stocks starting to climb rapidly, right? Why is it so easy to just throw that as like, oh, that's just a bear market rally and not consider the possibility that the stock market's right, like it almost always is? When the stock market makes a move that lasts several months, which remember, we really bottomed out on most stocks back in middle October, November. So we're on a multi-month rally. A bear market rally, you usually consider those as like something that lasts maybe a few days, maybe a few weeks. This has been multi-months now at this point in time, right? And when you see that, you kind of got us to say, does the market know something that I don't know? Maybe we're in a trough earnings period right now, and it's pricing that earnings are going to get a lot stronger for these companies, right? So who's to say the stock market's wrong and just the bond market's right? And once again, that's something the bears, they don't even take these things into account. It's like they only look at it one way. You've got to look at it from both sides, right? I understand what the bond market's saying. I also understand what the stock market's saying, right? Somebody's going to be wrong and somebody's going to be right, or maybe it's something in between.
Be possible, though, Michael, that the Fed, when you take a look at the Fed futures curve, that it's pricing and easing, but maybe that's a reflection of inflation just coming down a lot.
Sure, inflation can come off a fair bit, but we still don't know exactly what the destination is. Makes a big difference to the Fed if that's 3.25, 2.75. At this point, that's up in the air. We can't tell. Right now, it's running about 4% plus on core. That's too high for the Fed. We can get a huge number tomorrow. That's a bad result.
It's all about legacy, too. Arthur Burns was probably a brilliant economist, a great individual. He's become the punchline to a lot of inflation jokes. And I don't think Jerome Powell wants to be this generation's Arthur Burns. So I think part of it is about his legacy, and he doesn't want to be the guy that makes some of the same mistakes were made, 40 or 50, almost 50 years ago.
Yeah, absolutely. You think about Powell when he walks down that hall at the Fed, he says, Burns, I can't be that guy. I don't want to be number 2. I don't want to be number 3. I want to make sure there's a big gap between my legacy and that of Burns. And that gives Powell the incentive to really try to squelch inflation, keep policy rates high for quite a while longer than the market anticipates. So I think that's the danger right now, both for bonds and for stocks, frankly.
So, Michael, the Fed is known for taking too long to act, and as you just said, acting for too long. Is there a chance with this very political year that we are moving into, that we're always into, with employment, that Chair Powell doesn't want to keep his foot on the gas as long as you think he would? And we don't need a lot of cuts. We just need a leveling off of the hikes. Any shot of that?
Yeah, there's a chance. And I think the big risk there for Chair Powell is that he loses control of the committee. So a number of folks in the committee lean fairly dovish. if the economy does look a bit weaker, if the jobs picture does darken a fair bit, they may talk to Jay Powell and say, look, we can't go along with additional rate hikes. We probably need a cut or two fairly soon. He might lose that argument. I think that's the biggest risk for him with respect to his legacy.
Michael, it's Karen. So let me ask you, the market seems to want to interpret everything as a positive, but
in terms of Powell's legacy, okay, it's quite simple. If they engineer, let's call it not a hard landing or even a mid landing, and the soft landing does come, his legacy will be solidified as somebody that ran the Fed pretty darn good, because he was put into obviously an awful situation where, the government decided to shut down the world. It wasn't like the Fed decided that, right? The government, politicians decided to shut down the worldwide economy. And so then he and everybody at the Fed, right, was put in this horrible situation of unemployment going to pretty much the highest levels we've seen since the Great Depression. And they had to handle this awful situation, right? And part of that was they definitely added to inflation, but they weren't the only one. It was also the politicians, the states, local governments, federal government, that was all adding to that inflationary problem, along with supply chain. So everybody likes to just put on the Fed. It wasn't just the Fed. They were just a component of that. And if he somehow, navigated us through that, right, and navigates us into a soft landing, which we'll see if that happens. But if he does, I think he's going to have a legacy that will be up there with some of the greatest ever.
Anything that they can say that you would actually also think was a positive?
The big positive for us right now, frankly, is going to be in the data. It's not so much what the Fed says, it's what the market delivers data-wise. So if the economy actually does seem to be cooling a little bit, if CPI prints somewhat low tomorrow, we've got a call for 0.3 on core. Sarah House has done a great job there. If that materializes, that's the best sort of news that the economy and the markets can have. So it's less about the Fed talk, much more about the data at this point.
Michael, great to have you with us. Thank you.
Thank you.
Michael Schumacher, Wells Fargo.
I think there was an interesting article in the Journal this morning talking about China and what...
Every time I hear Michael Schumacher, I think about the great F1 driver, arguably the greatest of all time. Who knows about Michael Schumacher? Man, that guy was good.
Don't hold your breath waiting for them to reflate the global economy. And I thought one of the interesting points there was...
Hey, what is this? They got some sort of new studio set up? What is this all about?
This is going to be a domestic consumption story over the next year or so, and this could be as our economy is slowing. When you think about the effects of that, if they have demand for the sorts of inflationary inputs like energy and industrial commodities, that could be inflationary over here. We have also unemployment at 50.
No, this is no. This is the set that they do in the morning with Becky Quick and was it Joe Kernan or whatever, and the other dude. This is the set they're using. That's strange. I wonder what's going on with their other set.
3-year lows, that wage inflation, that has been really sticky. Now we're starting to see some layoffs, but it hasn't made its way through our economy really. So this could be like the perfect storm of stagflation. And it's not fear mongering or anything. This is just kind of picking it out, partially because the consensus, as I just said, has shifted so dramatically, so quickly, and the markets don't really seem to care about the data. And, Michael just made a lot of good points. Like if we start to see weakening data, and that might give the Fed a little more room to say, we're not going to be here for as high as long as you might think. But the market's not pricing that in right now, and that's the thing that concerns me.
Guy, I thought it was interesting, the question about legacy, the notion that he's thinking about his legacy.
Okay, so the market priced in a whole lot of that last year. When you saw the greatest companies in the world going down 30, 40, 50, 60, 70, 80%. It was pricing in like just about every bad scenario you could possibly imagine when you saw those stocks moving like that. I think sometimes we forget what happened in 2022, don't we?
He doesn't want to be in, as to quote David Zervos over at Jefferies, he says he doesn't want to be in the hell where Arthur Burns resides. He wants to be in the heaven where Paul Volcker resides when it comes to Fed luminaries and et cetera. But there's a backstop, isn't there, though? I mean, if you're thinking that he's thinking about his legacy, he also doesn't want to be the guy to tip the economy into such a deep recession or tip the markets into a deep bear market, right? It goes both ways.
Yeah, I mean, no, listen, without question, I'm sure, and you'll make fun of my age, but I guarantee there were a lot of people hating on Paul Volcker at the time, but history has treated him extraordinarily well. And if we had to endure some short-term pain on the way to being basically trying to be at least responsible once again, and be it so as it may, history has treated him extraordinarily kindly. And I think, I can't speak for Jerome Powell clearly, but I think you'd much rather...
I'm trying to cook dinner at the same time as doing this video. I do apologize.
Endure the short-term pain, the person that, for a brief period of time
tipped us into a slowdown than be the person that had us in this quagmire of inflation because he didn't have the wherewithal to fight the good fight. And again, you know, Arthur Burns, who I'd never met, obviously, I'm sure he's a lovely guy. The only reason people remember him is because he failed in the 1970s combating inflation.
Yeah, so, you know, my 2 cents on this whole thing, right? These bears, because, you know, the premise of today's video really is around these bears starting to capitulate, right? And goes back to that Steve Weiss gentleman. And they just play this market so dangerous. They really do. They play, like, on max level dangerous. These folks love to play these put options. They love to bet heavy on put options, especially when things are, like, ultra, like, many times you're going to see record amounts of put options going through when the market's already down significantly, right? And a lot of these bears, they saw the market down, you know, in terms of the NASDAQ, let's speak about, right? They saw the NASDAQ down 30, 35. At the peak, it was down like 37% plus, right? And they saw that, and it still wasn't good enough for them, right? They really wanted to see that NASDAQ go down 50% plus and the S&P 500 go down 50% plus. But in order to get the NASDAQ to go down 50% plus and the S&P 500 especially to go down 50% plus, you need pure panic, and I mean the purest panic, right? And I'm talking about through everything. I'm not just talking about retail. In order to get a 50% drop, you need panic in Wall Street. You need the financial system to nearly collapse. You need earnings of companies for the strongest companies in the world to go like pretty much negative. I'm talking about they start losing money for the strongest companies in the world. And we just haven't seen any of that, right? We've got the ultra levels of panic from retail, but it's not like there's no systemic risk like you had in the great financial crisis where it's like, oh my gosh, we could take down all of Wall Street. We could take down the biggest banks, right? Oh my gosh, they need bailouts. Like that's the type of shock and awe you're talking about back then, right? And in terms of retail, they panicked. They sold. That's why Robinhood users are down 10 million from the peak. 10 million monthly active users Robinhood's down. So you got retail to capitulate. You got a lot of fund managers to capitulate in 2022 and dump out of the market in mass, especially over the summer and into the fall time. Those people dip, man, and they went cash. They went wherever, right? And as long as, like, you know, you got to always position yourself for what's the likely probability over this next 5 years, right? And the likely probability over the next 5 years is the market does well. And these companies that are some of the best companies in the world are going to do very well. And companies like Meta, companies like Tesla, companies like Shopify, like countless of these companies are going to see their net incomes explode, right? And you're already seeing some glimpses of some companies doing some shocking things. Check out Palantir, right? Palantir was not supposed to be profitable on a GAAP basis for years from now. Now they're talking about in 2023, they're going to be GAAP profitable. It can change quickly with these companies. In a matter of 2 to 4 quarters, many of these companies can go from ultra spending like crazy to suddenly switching their business models, cutting down on costs and expenses in a major way, right? While their revenues also playing catch up there, increase margins, and next thing you know, all of a sudden you're like, how did this company go from crazy losses to profitable, right? These companies switch up quick, and they say, you know what, we're gonna sacrifice maybe some growth for profitability. And these are things that unfortunately a lot of market participants, and especially a lot of the perma bears, they don't take this stuff into account. And it's like, dude, you got to take this stuff into account because this is what changes the markets overall. So I hope you guys enjoyed today's video. As always, I appreciate every single person that subscribed to the channel. Thanks for being here, folks. And yeah, I think our once a year sale is going to be on as of right now. There will be pinned comment for access to that. Take advantage, learn lots, invest in yourself, and yeah, go through that course. Start out with stock market investing mastery portion, then go to becoming master of the stock market section, then go to dividend investing mastery section, then go through the bonus parts. And I can tell you the bonus parts is probably the most value of all of it. You're going to get a tremendous amount of value from that. Enjoy, learn lots, and appreciate y'all, and have a great day.